In this video, we're going to move into the second part of the balance sheet, which is known as the liabilities and shareholders' equity side. Now, in the previous lesson, we went through the assets side of the balance sheet for both Apple, or at least a version inspired based on Apple's financial statements, and then we compared it to a personal balance sheet, the asset side of a personal balance sheet, and we saw how items on there matched up and corresponded with many of the items on the corporate balance sheet for Apple over here. You also recall that on the balance sheet, assets represent the resources that can produce revenue or be turned into cash for you, whereas liabilities and shareholders' equity, the other side in the balance sheet, represents how you got those resources in the first place. Just like the asset side, on the liabilities and equity side, we are going to look at two snapshots in time from the beginning of the period we're looking at and then from the end of that period. So moving down here, you see the basic outline of the liabilities and shareholders' equity side of the balance sheet in front of you. We have current liabilities, so anything that lasts for under a year, and then we have long-term liabilities, anything that comes due in over a year, or anything that the company will have to pay out not in the current period, but sometime in the future, usually after a year. And then we have shareholders' equity here at the bottom. So once again, we're going to move through this and go through each of the items here, what it actually means, and how it relates to the rest of the financial statements. We're also going to take a look at Apple's own liabilities and shareholders' equity side of their balance sheet. In this case, it's not going to be terribly useful because, as you see, I pulled up their balance sheet right here from their financial statements. As you can see right here, their liabilities and shareholders' equity side of their own balance sheet is very, very simple and is actually missing quite a few of the items that I have on the Excel file. Now, the reason theirs is simpler is that they don't have any debt, first off, so they have no items for long-term or short-term debt, for example. And then overall, Apple is much simpler than some of the other companies that you come across. So you see the items here for current liabilities, accounts payable, accrued expenses, deferred revenue. Those are all common, and we're going to get to those in our own Excel model. But there are a couple other items here that they don't mention that I do want to bring up. Then they have non-current deferred revenue and then other non-current liabilities. The problem here is that they're just missing a lot of common items that could come up, so I will diverge from what they have in their filings here. This is a good starting point, and it's good to be familiar and understand what these items actually mean in the context of Apple, but we're going to be diverging from this because I want to show you some other important items that do not show up on their financial statements. Then under shareholders' equity, you see that even here they're missing quite a few items. So they have common stock, retained earnings, and then accumulated other comprehensive income. And if we go back to our own balance sheet, you see that they're missing treasury stock, and then they're also missing this additional paid-in capital line. So since they're missing all those items, I want to stick to our own version instead and then explain some of these items in the context of Apple, but not literally use their exact financial statements. So starting from the top here, the revolver, the first liability that you see, it is very similar to a credit card on your own personal balance sheet. The purpose of a revolver is so that a company can borrow cash for short-term funding needs. So let's say, for example, that a company needs to make payroll and pay all of its employees, and it doesn't have enough cash at the moment. Well, what they might do is draw on their revolver, similar to how if you need extra money for a short period, you might use your credit card and then pay back the funds right after that. A revolver is pretty much exactly the same, but for a company rather than for an individual. So any type of short-term funding need for a company would be funded by its revolver. Usually you would not use a revolver for something that's longer term. So for example, if the company wanted to buy additional property, plants, or equipment here, normally they would not fund that with a revolver because a revolver is a short-term or current liability, whereas PP&E is a long-term asset. So the revolver is used more for funding some of its current assets or for funding any income statement expenses that are particularly high for a given period. Moving down, accounts payable. Remember that on the asset side in the balance sheet, we had this other item, accounts receivable, which is sort of like IOUs owed to you by friends. Well, accounts payable is the opposite. Whereas accounts receivable is what the company is expecting to get from customers in cash in the future based on services or products they've already delivered, accounts payable represents what the company itself, Apple here, owes to vendors or suppliers or anyone else who it has bought product from to assist in its own business. So for example, for Apple, accounts payable, let's say that they have ordered inventory from a manufacturer in China or Taiwan, let's say, and they have received the inventory. They're going to be using it to manufacture iPads or iPhones or iPods, but they have not actually paid them in cash yet. So they have the invoice from the company for this huge order, but they haven't yet paid it in cash. That's an example of something that would show up under accounts payable because in effect it's an IOU. Apple is saying, we're going to pay you for this at some point in the future. You've already delivered the product or service to us, we're using it, but we have not paid you quite yet. We will get it back to you shortly though. Usually accounts payable and accounts receivable last for a very short time period, often under 30 days, sometimes less than 90 days. Sometimes it can go over that, but usually it's taken as a problematic sign if it lasts for much longer than 90 days. So these are very, very short-term current liabilities or assets in the case of accounts receivable. Accrued expenses and deferred revenue, neither of these have a good analogy in the real world, so I'm not even going to attempt to explain them with a real-world analogy. But accrued expenses represent anything that the company has been expensing on its income statement over here, but which it is not actually yet paid out in cash. So for accrued expenses, the classic example here is paying employees. So let's say that we pay employees each month and that internally we actually create an income statement every week or every 2 weeks, let's say. Well, what would happen here is that since we pay employees in cash at the end of the month, for accrued expenses, on our weekly or bi-weekly income statements, we would still record salary paid to employees right here, and that would still be listed as an expense on our income statement. When we record that, our accrued expenses line item here goes up. But remember, these are non-cash expenses if we have not paid them out to employees in cash yet. So what happens is, over time, over the course of that month, those expenses accrue, and we keep recording those expenses, the employee's salaries, on the income statement, and then at the end of the month, we pay them out in cash. At that point, the accrued expense line item goes down, and then our cash balance on the asset side also goes down. So that is roughly how accrued expenses work. Accrued expenses are used for regular items like salary and wages, anything that's on a recurring basis, whereas accounts payable usually refer to specific invoices for individual orders, for engaging the services of a law firm or an accounting firm that only happens once a year or very infrequently. So that's the basic difference between these two. Deferred revenue, again, does not have an analogy in the real world, but deferred revenue represents cases where the company has received cash for a product or service, but they have not actually delivered that product or service yet. So the best example here for Apple, let's say that you buy an iPhone for them and you buy a 2 or 3 year subscription. You pay for the subscription upfront in cash, so they get the cash. Their cash on the balance sheet goes up, and the deferred revenue goes up. But what happens is that even though you've paid them for all 3 years upfront, they haven't actually delivered the service to you yet. So what would happen here is that as they deliver the service over 3 years, the deferred revenue balance would go down, and they recognize it as revenue on the income statement. So the revenue here goes up as they recognize the income from the 3 year subscription you bought, even though you paid them in cash up front at the very beginning of those 3 years. With deferred revenue, it's very important to keep in mind that it always represents situations where you actually get the cash up front and you simply recognize it as revenue on the income statement over a period of time, months or years in the case of deferred revenue if it happens to be a long-term deferred revenue item under long-term liabilities. The reason why deferred revenue is a liability, it doesn't make sense to some people. It is a little bit counterintuitive. The reason it's a liability is because if you think about it, when someone pays you cash to perform a service or to deliver a product, you now have an obligation to perform that service or deliver the product. So in a sense, it's as if someone has a commitment from you and you now have an obligation to perform whatever they requested, whatever they paid for up front. So that's why it's considered a liability. If you look on the asset side, items like accounts receivable, this is an asset because you've already performed this service. You've already performed the service or delivered the product, and you're just waiting on another person for the cash. Whereas in this case, it's the opposite scenario. You have not performed anything yet or delivered anything yet, but yet you already have the cash from someone else. So that takes us to the end of current liabilities. Now for long-term liabilities right here, the most common one The most common ones here are long-term debt, very similar to mortgage or a car loan or even a student loan, any type of debt that's going to last for a long period of time here. You pay interest on this debt, and the interest, of course, shows up on the income statement under interest expense right here. And also on this debt, you may repay the principal, but that does not show up on the income statement. It doesn't show up on the balance sheet. It will show up on the next statement we get to in the video after this. Long-term debt versus the revolver. The revolver is generally good for a very short period of time. You are repaying it constantly, whereas long-term debt generally lasts for many years, and that's why it's a long-term liability. Deferred tax liabilities, very similar to back taxes in the real world. So in the real world, you may owe the government money if you haven't paid sufficient taxes or you haven't paid any taxes, for example. And a company may similarly owe the government money if it hasn't paid sufficient taxes. So let's say that it takes a lot of aggressive deductions on its income statement. Well, the government can come back and say, actually, you owe us more in taxes, or actually, according to the tax code, you're going to have to pay more in the future. And that's what a deferred tax liability is. The government or the tax accountants say that they have to pay more in the future to make up for not paying enough taxes in the current or the previous periods, and that is why it shows up as a liability. On the asset side of the balance sheet, you could have a deferred tax asset, and that's the opposite. That's a case where you're going to get a tax break in the future because you've overpaid on taxes. And that actually shows up on Apple's balance sheet right here, deferred tax assets. We skipped over that because I wanted to cover it in the second video instead, but that scenario is also a possibility, so you could have both deferred tax assets and deferred tax liabilities. And then this other item here, other long-term liabilities, again, very simply a catch-all. One very common item to have here are pensions and pension-related liabilities. You can also have restructuring liabilities. Pensions, of course, refer to what the company owes to its employees who are retiring, yearly or monthly payments to them after they've reached the age of retirement. Auto companies like GM, Ford, and so on got into a lot of trouble because their pensions were very, very high. So if you look at their balance sheets, the other long-term liabilities or pensions on their balance sheet are very, very high, and that's one of the reasons why the companies ran into so much trouble. Then we get to this next section, shareholders' equity. This one does not really have a good analogy to the real world, so again, I'm sort of skipping over it because it just doesn't make that much sense. There's really only one item that can be compared to something in the real world. The rest of these are all very specific to companies instead. Common stock represents how much the company has issued in terms of the paper value of that stock. So normally when a company is IPOing or selling stock to investors, the stock has a paper value, a book value, and then a market value. So the book value might be 1 cent, which we're going to enter as 0.01 right here. And then let's say they have 100 shares outstanding in the market right now. So you can see how the math here works. 100 times the 0.01 right here gives us this value of 1 that we see for common stock. And then let's say that the market value of these shares, so when you go and log into your TD Ameritrade or your E-Trade account or any brokerage account, you can buy them through that account on the open market for 20 cents instead. So this reflects the market value that you could get for these shares when you buy or sell them. There are still 100 shares outstanding up here. So let's see what the total market value of the shares is. It would be the 20 cents times the 100 shares. So it's 20. But remember that additional paid-in capital reflects the value over the value of the common stock, the par value here. So actually in this case we would record 19 for this value, and this is a quick example of how we could get to 1 for common stock and then 19 for additional paid-in capital. Treasury stock right here is the opposite of these two items. So treasury stock represents stock that the company has repurchased. So let's say that Apple decides to repurchase 100 shares, and their shares are currently trading at $20 a share. Well, if they repurchase all 100 shares and it's trading at $20 a share, they would get a negative 2,000 line item. Treasury stock is always going to be a negative value, assuming that they have actually repurchased shares. It's listed with a negative value to denote that it is the opposite of these two line items. These two line items represent shares that are out there in public hands, whereas treasury stock has a negative sign because it's the opposite. It's not out in the public. It is instead held closely by the company, and no one else can get a hold of it. So that's why it has a negative sign. The next item here, retained earnings, this one has a fairly close analogy to the real world. Retained earnings is basically what the company has saved up over time out of its net income. So over time, the company earns something in terms of after-tax profit, net income here, and then it either saves it up under shareholders' equity on its balance sheet and reinvests it into the business, or it pays it out as dividends to shareholders. Now, in real life, of course, you don't have dividends, but you can think of this as retained after-tax earnings. So as you earn money and as you pay taxes on it, you're going to save some of that money, and then when you save it, you can use it to fund some of the assets that you have. And it works just like that for a company. They have these retained earnings, and they can use these to fund the purchase of some of their assets on the other side of the balance sheet. And that's why they're listed as a liability or shareholders' equity line item right here. Note that retained earnings, I have it listed here, cumulative net income, it's not the same as cash. The difference is that cash is an asset, and cash does not necessarily have to be reinvested into the business, whereas retained earnings is what the company has saved solely from its net income, its after-tax earnings, and retained earnings are always going to be reinvested into the business or paid out as dividends to investors in the company. So retained earnings and cash are related, but they are not the same thing, so make sure you get that right and don't get it confused in models. And then the last item here, accumulated other income, I've just abbreviated that. If you go to Apple statements, they've listed it as accumulated other comprehensive income. This item is simply for any miscellaneous changes that don't fit in anywhere else. The most common one is for items like the exchange rate effect. So companies like Apple that operate globally across many different markets sell their products in all sorts of different currencies. Those currency exchange rates may be going up or down. So when they trade that currency back into US dollars, they may take a loss on it, they may have a gain on it, and you record those types of changes here under accumulated other comprehensive income. So that's a quick overview of all the items on the liabilities and shareholders' equity side in the balance sheet. Of course, there are other items. This is not it. You will see other items, but these are really the key ones that you need to know. And as we go through the course, you're going to learn about other items here, but you can pick it up very quickly as long as you understand the basics, because these are really the most common ones that you'll see on most standard companies' balance sheets. Now, as a final exercise here, I'm going to go in and add up all the liabilities and shareholders' equity and make sure that our assets equals our shareholders' equity plus liabilities here. So for current liabilities, I'm going to enter equals and then sum those up, and then do the same for total long-term liabilities. For total liabilities, I'm going to enter equals and then sum these two up. Then for shareholders' equity, I'm going to do the same thing. And then let's sum up everything here. Total liabilities and shareholders' equity. We're going to take total shareholders' equity plus total liabilities. We get to 865, which matches the 865 under assets. This is a good sign. If our balance sheet did not balance, our model would be completely wrong. Your model can never be correct if the balance sheet does not balance. So be really careful of this and be on the lookout for it. It's one of the most common mistakes that you'll see in models. We can also just do this quick balance check down here. And what we can say is we can go up to our total assets, and then we can subtract liabilities and shareholders' equity. We get an OK there because the balance sheet balances correctly. Now, if you look at these numbers and use some intuition here, you can see roughly what is funding what. Because remember, liabilities and shareholders' equity tell you how you're funding all those assets and all those resources that you have now. So if you look at the numbers here, clearly the mortgage is going to be funding the house and car. Obviously more the house than the car here. It's not an exact analogy, but this one is most strongly correlated with the house and the PP&E on the personal balance sheet here. Then these other items, it's not clear exactly what they're going into, but the credit card and IOUs, these are most likely funding the current assets here. So maybe they need to get some additional cash in their checking account to buy something or to pay for some kind of vacation they need. That's going to be funded most likely by the credit card or possibly by the IOUs. And same for the insurance policy and the cash in the savings account. Now if we go further down, the back taxes here, It's not clear exactly what they're funding. Remember that the reason these count as a funding source, the reason why deferred tax liabilities count as a funding source, is because if a company is not paid taxes, that means that it has extra available to pay for some of their assets. It's saving money on taxes, and it can take some of that money it's saved and devote it to purchasing assets and investing in assets on the other side. Then retained after-tax earnings. This one most likely is going to be funding the retirement savings plans. It may be funding the stock market investments, and it could even be funding some of the current assets right here as well. So that just gives you an idea of roughly how we're funding everything. And again, the most important point, our liabilities and shareholders' equity equals our total assets, so the balance sheet balances, and we're set here. For your exercise, what I want you to do is very simple. I just want you to sum up everything on Apple's balance sheet, or our version of Apple's balance sheet right here. Current liabilities, long-term liabilities, total, and then total liabilities and shareholders' equity, and then complete this balance check. Once you've done that, we are going to go through the exercise together, and then I'm going to review everything we went through and go over a few of the finer points here in more detail, just as one final review for this lesson. So pause the video right now and try to sum up everything on Apple's balance sheet right here on the liabilities and shareholders' equity side. Okay, good. So here's what we can do to sum up everything. First, I'm going to press Alt equals to sum up current liabilities. And then for long-term liabilities, Alt equals again. For total liabilities, I'm going to take long-term, enter a plus sign, then use Control and the arrow keys to jump up. And then for shareholders' equity, Alt equals again. And I can take shareholders' equity and then use Control keys again to jump up. So we get to 140 million. Let's do our balance check now and go up to total assets and then subtract total liabilities and shareholders' equity. And so our balance sheet balances. So that is an overview of the balance sheet and how we add up everything and ensure that it actually balances correctly. Just to review the items, I have some key notes here for different items that we went over on the liability side. Remember that the balance sheet shows the resources, the assets, and then how you got them, liabilities and shareholders' equity. The two sides must always equal each other in balance. It's always a snapshot in time, the beginning and end of a period. Current means under a year. Long-term means over a year. You have a review of all the liability items here. Revolver is like a credit card. Accounts payable like IOUs. Accrued expenses have been recognized on the income statement, but the cash is still owed. Deferred revenue, the cash has been collected, but the service or product still needs to be delivered. Long-term debt, very similar to long-term debt in real life, like mortgages or car loans. Deferred tax liabilities, back taxes, anything that you're going to owe in the future. Other miscellaneous items like other types of debt, pensions, and restructuring obligations. And then shareholders' equity. Common stock is the paper value of the stock. Additional paid-in capital is the market value minus the book value. Treasury stock is what they've repurchased. Retained earnings, what they've saved up over time, minus dividends. And then accumulated other comprehensive income is for miscellaneous items like exchange rate effects. Two other questions I want to address and make sure are crystal clear. I've gotten some questions on the difference between some very closely related items on the balance sheet, specifically accounts payable versus accrued expenses, and then accounts receivable versus deferred revenue. So we're going to look at the first one here, accounts payable and accrued expenses first, because the difference here is much more subtle. For both of these, if you look at my categories here, service delivered, paid out in cash, and initially on income statement, they're almost the same. So for accounts payable, this might correspond to, say, a law firm that provides its services to Apple. So they get the legal services, the law firm sends them the invoice. They have not yet paid it out in cash, but they do reflect it on the income statement, accounts payable, just like accounts receivable on the other side shows up on the income statement. With accrued expenses, you have a similar type of situation. So here it might refer to an employee's salary. The employee works, so they deliver the service, and they accrue that salary over time. It is not yet paid out in cash if it's listed under accrued expenses, but it is reflected on the income statement, and you do see it there for anything that accrues over time. So what is the difference if they're exactly the same accounting-wise? Well, really the difference here is what they're used for. Accounts payable is generally used for specific invoices, such as legal services, buying inventory, anything that occurs infrequently or is at least not a recurring expense. Whereas accrued expenses are more for things like employee salaries, wages, utilities, anything that recurs month after month or week after week, and is accrued over time and then paid out in cash at the end of a period. So they're very similar, and really the main difference is what they're actually used for. Many companies actually combine these two and list them as either just accounts payable or accrued expenses, so you do see that treatment as well. Then this other one, accounts receivable versus deferred revenue. This one is much easier to explain because the differences are more dramatic. So accounts receivable and deferred revenue both relate to items that are going to turn into revenue or have already been reflected as revenue on the income statement of the company. The difference is that accounts receivable is for a service that has already been delivered, whereas deferred revenue is for a service that the company has not yet delivered. So accounts receivable, you go into the store and buy an iPhone, but you do not pay in cash, you pay with your credit card. Well, if that happens, Apple still records it as revenue on their income statement, but they haven't gotten the cash from you yet, and they have delivered the product in this case because you have the iPhone in your hands. Deferred revenue, well, in this case, let's say you sign a 3-year contract for that iPhone. You pay for everything upfront in cash, so it goes directly to the company's cash on its balance sheet, but they haven't delivered the service yet because it takes place over the course of 3 years. It is not on the income statement initially when you first pay for this because they recognize it over 3 years. According to the matching principle of accounting, you can only recognize expenses and revenues as the services or products associated with them actually get delivered, and so that explains the difference between deferred revenue and accounts receivable. They're really inverses of each other in this case. So that takes us to the end of our videos on Apple's balance sheet and balance sheets in general, how the personal balance sheet of an individual might compare, and what each item here actually means. Coming up next, we're going to go into the final major financial statement, the cash flow statement for Apple. And we're going to see how that compares to a personal cash flow statement and how we can use the cash flow statement to link together the income statement and the balance sheet and come up with the new version of the balance sheet over here. You'll also understand why the cash flow statement is necessary and how it sort of ties together everything that we've done so far, and why arguably it's the most critical financial statement to look at when you're analyzing a company.